Hello, everyone. If you're trading but keep making the same mistakes every month, if you don't understand why your profits disappear, or if you're taking good trades but still not growing consistently, then this video is for you. Most traders don't lose money because they lack a strategy. They lose money because they don't know what mistakes they're making. And that's exactly where a trading journal can change everything. A trading journal is a record of every trade you take. It contains important information such as which stock or asset you traded, entry price, exit price, stop loss, risk taken, trade result, and most importantly, your thought process. A trading journal is much more than a spreadsheet. It's a mirror of your trading behavior. When you review 50, 100, or 200 trades, patterns begin to appear. You discover what's working and what's costing you money. Every successful trader keeps records. Think about professional athletes. A cricket player tracks every match. They know their strengths, their weaknesses, their performance statistics. Trading is no different. Professional traders know which setups work best, what time of day they perform best, what mistakes they repeatedly make. Without records, you're simply guessing. With records, you're making data-driven decisions. The good news is that you don't need expensive software. You can use Microsoft Excel, Google Sheets, Notion, OneNote, or a physical notebook. Personally, I recommend Google Sheets or Excel because they make analysis much easier. The tool isn't important. Consistency is. The first section of your journal should contain basic trade details. Create columns for date, stock name, buy or sell, entry price, exit price, quantity. Example, date, June 10, stock, Reliance, entry price, 1500, exit price, 1530, quantity, 100, profit, 3,000 rupees. This creates the foundation of your trading database. This is where many traders fail. Trading success isn't determined by entries, it's determined by risk management. Create columns for stop loss, risk per trade, risk to reward ratio. Example, entry 1500, stop loss 1490, target 1530, risk 10 points, reward 30 points, risk to reward ratio 1 to 3. Tracking this information helps you understand whether you're taking quality trades. This section helps identify your most profitable trading setups. Examples include breakout, pullback, trend following, reversal, support and resistance. Every time you take a trade, label the setup. After a few months, you'll discover which setup generates the best results. Many traders are surprised when they realize that most of their profits come from just one or two setups. In today's video, I'll show you how to set up a professional trading journal that can help you identify mistakes, improve discipline, and become a consistently profitable trader. By the end of this video, you'll know exactly how to create a trading journal and use it like professional traders do. So let's get started. This is one of the most overlooked parts of trading journals. Most traders record numbers. Very few save screenshots. For every trade, save entry screenshot and exit screenshot. Screenshots allow you to visually review your decision-making process. Months later, you'll be able to see exactly what you saw when you entered the trade. This becomes incredibly valuable for learning. Ask yourself one question: why did I enter this trade? Examples: breakout with high volume, trend continuation, support bounce, moving average rejection. If you can't clearly explain your reason for entering a trade, you probably shouldn't take it. A good trade always has a clear reason behind it. This section can completely transform your trading. Create columns for emotion before trade, emotion during trade, emotion after trade. Examples: before trade, confident; during trade, fearful; after trade, regretful. Over time, you'll notice emotional patterns. Maybe you close winners too early because of fear. Maybe you hold losing trades because of hope. Maybe you overtrade after a winning streak. Your emotions often reveal problems that your strategy cannot. After every trade, ask yourself, what mistake did I make? Examples: entered too early, entered too late, ignored stop loss, overtrading, revenge trading, FOMO entry. This section is one of the most important parts of your journal. The goal isn't to avoid mistakes completely. The goal is to stop repeating them. Every trade teaches something. Winning trades teach, losing trades teach even more. After every trade, write one lesson. Examples: always wait for volume confirmation. Never move a stop loss. Avoid trading during low volume sessions. Follow the trading plan exactly. Over time, these lessons become your personal trading handbook. Now let's talk about reviewing your journal. Every weekend, spend at least 30 minutes reviewing your trades. Ask yourself, how many trades did I take? How many were winners? How many were losers? What was my biggest mistake? What was my best trade? What did I learn this week? This review process is where improvement actually happens. At the end of each month, analyze your performance. Focus on win rate. How many trades did you win? Average winner. How much do you make on winning trades? Average loser. How much do you lose on losing trades? Total profit and loss. What was the final monthly result? Numbers don't lie. They reveal the truth about your trading. Let's say you completed 100 trades, 50 winners, 50 losers. Average winner, 3,000 rupees. Average loser, 1,000 rupees. Many beginners might think a 50% win rate is bad, but let's do the math. Total profit, 50 times 3,000 equals 150,000 rupees. Total loss, 50 times 1,000 equals 50,000 rupees. Net profit, 100,000 rupees. You don't need a 90% win rate, you need proper risk management. That's what professional traders understand. Common trading journal mistakes. Mistake number 1, recording only losing trades. Record every trade, good and bad. Mistake number 2, never reviewing the journal. Collecting data is useless if you never analyze it. Mistake number 3, ignoring emotions. Many trading losses come from psychological mistakes, not strategy failures. Mistake number 4, being inconsistent. A journal only works if you update it regularly. Consistency creates results. Many people believe successful traders have secret indicators. Others think they have special software. The truth is much simpler. Successful traders improve faster than everyone else, and they improve faster because they track everything. Their journal tells them what's working, what's not working, what needs improvement. That's their real edge. Starting today, create a simple trading journal with these 10 columns: date, stock name, entry price, exit price, stop loss, risk to reward ratio, setup type, trade reason, emotion, lesson. Then commit to recording every trade for the next 30 days. No exceptions. At the end of those 30 days, you'll understand your trading better than ever before. Remember this, the market rewards traders who learn from their mistakes, and the fastest way to learn from your mistakes is through a trading journal. A journal won't guarantee profits, but it will help you become more disciplined, more aware, and more consistent. And consistency is what creates long-term success in trading. If you found this video valuable, make sure to like the video, subscribe to the channel, and comment below what platform you use for your trading journal: Excel, Google Sheets, Notion, or something else. Thank you for watching. See you in the next video. Happy trading!